Hello, Marc Oswald from ADM Investor Services International with some thoughts on what's been going on in financial markets and the various measures which have been undertaken to try and combat both the spread of the COVID virus in fiscal and in monetary policy terms and in terms of markets. So my first chart this week is the US trade-weighted index, a dollar trade-weighted index. And as one can see, it's been a story of markets initially reacting to the narrowing of the US versus Germany 10-year spread, and indeed the other major currencies initially going down before having a massive spike as everyone realized that with the global trade shutting down, there was going to be a big dollar shortage in the economy internationally, particularly in terms of offshore dollars, and scrambling above all ahead of quarter end for dollars. There has been some alleviation with the Fed promise of QE infinity, and indeed the US plans to enact a $2 trillion stimulus package. However, when one looks at it in the greater scheme of things over the past year, we are still in an upward trend, even if we've had this big outlier spike and increasing the volatility in it. And if we go to my second chart, one can see precisely what impact we've been having in terms of all the monetary policy easing on long-term bond yields. I've got the US 10-year and the German 10-year. Basically, one can see in terms of the German 10-year, yes, the ECB may have gone with its special QE program, alleviated some of the tensions in peripheral spreads, but in terms of the German 10-year yield, basically, we've not really been doing anything other than trading in a well-established range, whereas the US has been hitting new lows. We obviously hit a 28 basis point low on the US 10-year, and we're back at 75 now. I think in the longer run, there will be some upward pressure on the US 10-year and the US 30-year yields, i.e. curve steepening pressure from all this extra issuance. Mr. Mnuchin has obviously promised us a lot more 30-year issuance to fund this $2 trillion package. So in terms of what the Fed's actually done, how does that look in terms of alleviating US financial conditions? Well, first of all, we've got the US Financial Conditions Index. This is the Bloomberg version. As one can see, that white line is at extreme levels, obviously extremely tight levels, that means, in terms of financial conditions. And all the Fed's measures, which is the yellow line, which one can see, the Fed's balance sheet has expanded at an exponential rate to a new record of $5 trillion, has only alleviated US financial conditions a little. One shouldn't really be surprised by that. The fact of the matter is, whatever they do isn't going to change the perspective that we have no visibility on when we are going to reach a peak, both in Europe and indeed in North America, in terms of the spread. And only then can we expect to get some idea of when economies might be able to start to return to normal. And in the meantime, we're looking at the amount of damage that the various lockdowns and shutdowns and disruptions to economic activity are creating. So we come to my fourth chart. That's the S&P 500 versus the US high yield average credit spread. This is a chart which I use very often, as you know, and the two are still very closely correlated. And as one can see, there has been some tightening of the US credit spreads, but the S&P 500 and the S&P 500 has made some gains. However, my final chart points to the fact that we are going to see, which is about US corporate downgrades, which are being following through at record levels at the moment, even higher than any of the other spikes that we've seen. And that basically means there's a lot of trouble in US corporate land ahead. Therefore, one shouldn't expect the S&P 500 improvement to be anything other than a quarter-end phenomenon. A lot of invisibility out there, a lot of volatility likely to remain, even if not at the sort of levels that we've been seeing.